there is a number most people have never seen. It's not your salary. It's not your savings account balance. It's the number that decides whether your money outlives you or you outlive your money. And the wild part? Most people never figure it out until it's almost too late. Right now, there are people sitting on portfolios worth hundreds of thousands of dollars, and they are terrified to spend any of it. Not because they're greedy, because they don't have a system. They don't know how to turn a pile of investments into something that actually pays them every month. Today, I'm going to show you the exact ETF framework that fixes that problem. It uses 3 layers of funds, SCHD, JEPI, and JEPQ, working together like a paycheck machine. It handles market crashes without forcing you to sell anything at the wrong time. And it works inside a Roth IRA so the IRS can't touch a single dollar of it. I'm Volky. This channel is about the money stuff that actually matters. And what I'm about to walk you through is one of the cleanest income strategies in modern investing. Stay with me. This one's worth it. Picture this. The market drops 30% in the first year after you retire. Not a hypothetical. That literally happened in 2022. It happened in 2008. And the people who got absolutely wrecked weren't the ones who invested badly. They were the ones who had no plan for where the money was coming from. So they sold. They sold stocks at the bottom just to cover rent and groceries. And by the time the market bounced back, they'd already locked in the loss. That's the trap. It's not about picking the wrong stocks. It's about having a portfolio that forces you to make the worst decision at the worst time. Now here's what the other group did. The people who slept fine through all of it. They had income coming in monthly from ETFs they'd already set up. The market could do whatever it wanted. Their account still posted a transfer every single month. No panic, no selling, no problem. That's not luck. That's structure. That's a system. And today I'm going to break that system down for you step by step. Starting with why the normal index fund and prey approach quietly fails people in retirement. The problem nobody warned you about. Here's the thing about index funds. They're incredible at one job. That job is growing your money while you're still putting money in. You're buying shares, reinvesting dividends, letting compounding do its thing. Perfect. But the moment you retire, the game completely flips. You're not adding anymore, you're withdrawing. And that changes everything. Because now the order of your returns, not just the average, starts to matter enormously. There's a name for this. Sequence of returns risk. 2 people can retire on the same day with identical portfolios and identical average returns. But if one person gets their bad years early and the other gets them late, the results are completely different. The person who gets hit early, selling shares while prices are down, never fully recovers. The person who gets the bad years later, they're fine. Same average return, totally different outcome. That sequence of returns risk in real life. And this is the part that keeps financial planners up at night. Because you can't control when the crash happens. You can only control your structure going into it. Why, your generation has a different challenge. Here's why this matters even more if you're in your 20s or 30s right now. 75% of General Z and 81% of millennials already hold ETFs in their retirement accounts. That's according to 2025 data. So the investing habit is there. The discipline is there. The part most people haven't thought through yet is the withdrawal side. What happens when you actually need to start using this money? And here's the other thing. You're not building for a 10 or 15-year retirement. If you're 30 today and you retire at 60, you might need this money to last 30 or 40 years. The strategy that got you to retirement is not the same strategy that gets you through it. That's not a scary thing. It's just a planning thing. And the people who figure this out early, even just intellectually, have a massive advantage. Enter the income ETF. So what do the people who don't panic sell do differently? They've built portfolios that generate income on their own, without them having to sell anything. The tool they use, increasingly, is a category of ETFs designed specifically to pay you. We're talking about dividend ETFs and covered call ETFs. And in 2025 and 2026, this category has absolutely exploded. SCHD, the Schwab US Dividend Equity ETF, hit $83 billion in total assets. JEPI, JPMorgan's covered call fund, has attracted billions from income-focused investors globally. JEPQ, the Nasdaq-focused version, paid between 44 cents and 62 cents per share every single month last year. These are not obscure instruments. They are some of the most widely held funds in the world right now. And the reason people keep pouring money into them is simple. They pay every month, whether the market is up, down, or sideways. That changes the psychological experience of retirement in a way that numbers alone can't capture. You stop checking the market every morning to see if you can afford your month. The income just shows up, like a salary you never had to ask for. Now let me show you exactly how this is structured, because the magic is in the layering, and there are 5 stages to this that most people never put together. But once you see how it works, you can't unsee it. Let's get into it. And when you get to the end of this, there's something I need to tell you about what? See, coming next. So stay till the end. Let's go. The foundation layer SCHD. Stage 1 is your foundation, and the fund that anchors it is SCHD. The Schwab US Dividend Equity ETF, $83 billion in assets as of 2025. Some of the smartest money in the world is in this thing. CHD only holds companies with a long history of paying and growing their dividends. No speculation, no startups. The yield right now is around 3.2%. That's not huge. But here's why it matters. The dividend growth rate over 10 years has averaged 9.29% per year. That means if you're 30 and you build a SCHD position today, by the time you're 60, your yield on cost could be double digits. You bought at 3%, but your actual income relative to what you paid has compounded way past that. SCHD is your inflation fighter. The income doesn't just sit still, it grows with you. That's stage 1, stable, growing, tax efficient. The base of the machine. The income engine JEPI. Stage 2 is where you pump up the yield, and the fund here is JEPI, JPMorgan Equity Premium Income ETF, actively managed. Covered call strategy. What that means, JEPI holds a bunch of lower volatility S&P 500 stocks. And then it sells call options on top of those positions to generate extra cash. That cash gets paid out to you as income every month. In 2025, JEPI paid out $4.99 per share across the year, up from $4.42 the year before. That works out to roughly a 7.5% annual yield at current prices. If you had $200,000 in JEPI, you're looking at around $15,000 a year in distributions. Monthly. Predictable, without selling a single share. The trade-off is that JEPI caps your upside in strong bull markets. You're giving up some gains in exchange for income certainty. For someone who needs cash flow, that's not a sacrifice. That's the whole point. The growth kicker, JEPQ. Stage 3 adds a growth dimension through JPQ. Same covered call structure as JEPI, but based on the Nasdaq 100 instead of the S&P 500. That means you're getting income exposure to the biggest tech companies in the world. Apple, Nvidia, Microsoft, without going all in on growth stocks. JEP's trailing monthly payouts in 2025 ranged from 44 cents to 62 cents per share. At a $60 share price, that's roughly 8.1% annually in distributions. Higher yield than JEPI, but slightly more volatile because the Nasdaq moves harder. So you're balancing JEPI's stability with JEPQ's higher output. Together, stages 2 and 3 are your income engine. The money that flows every month without fail. The safety valve, bucket strategy stage 4, is where you protect everything you've built. This is called the bucket strategy. And it's what makes the whole system crash-proof. Here's how it works. You divide your money into 3 buckets. Bucket 1, cash. 1 to 2 years of living expenses. Sitting in a high-yield savings account. Not invested. Bucket 2, your income ETFs, SCHD, JEPQ. These feed Bucket 1 automatically every month. Bucket 3, long-term growth. Index funds, growth ETFs. You don't touch this for 10 years. Now here's why this diffuses the sequence of returns bomb. When the market tanks, and it will, you don't sell anything. Bucket 1 covers your life. Bucket 2 keeps generating income even in a down market. It refills Bucket 1. Bucket 3 gets to sit there and recover without you touching it. You literally remove the scenario where you're forced to sell low. Between January 2005 and December 2024, 6 of the S&P 500's 7 best single trading days came right after the worst days. The people who didn't panic, who had a structure that kept them from panic selling, captured those recoveries. The bucket strategy is how you build that structure before the crash arrives. The tax shield Roth IRA location stage 5 is the thing that most people skip and then regret. Where you hold these ETFs matters as much as which ETFs you hold. JEPI and JEPQ distributions are typically 60 to 80% ordinary income. In a regular brokerage account, that income gets taxed at your normal rate. That's the silent drag on your yield. The fix? Hold your high-yield ETFs inside a Roth IRA or traditional IRA. Inside a Roth IRA specifically, every dollar of that monthly income grows and eventually distributes completely tax-free. That 7.5% yield from JEPI? Inside a Roth, you keep 100% of it. Zero tax due. According to 2026 data, over 55% of millennials and General Z are already using Roth IRAs. That's the right instinct. The next step is making sure the right funds are sitting inside them. High-yield covered call ETFs inside your Roth. Lower yield, more tax-efficient SCHD in your taxable account. That single decision can add thousands of dollars a year to your actual take-home income. And it costs you nothing. It's just knowing where to put things. That's the full machine. 5 stages. Working together. Running quietly in the background. Finally. So let's land the plane. SCHD is your foundation. Slow, steady, dividend-growing income. JEPI is your engine. 7.5% monthly distributions. Lower volatility. GLQ is your kicker. 8% from Nasdaq exposure. Slightly higher upside. The bucket strategy is your crash protection, so you never sell at the wrong time. And the Roth IRA is your tax shield, so the government doesn't take a cut of the machine you built. None of this is exotic. None of this is gambling. It's just structure. And the people who built this structure early, whether they're 25 or 55, are the ones who retire without fear. Drop your questions in the comments. Seriously, I read every one. And if this shifted something for you, like the video, it helps more people find this channel. Now, before you go, there's a version of this strategy that most financial influencers want. Number 8. It involves a specific type of ETF that can push yields past 12% a year. The risk is real, the reward is real, and the question is whether the math actually works, or whether it's just a yield trap. Thanks for watching our video, and you. We're going to want to see it before you touch anything in that space. Stay tuned with us.